This is Tax Chats. Hello, I'm Scott Dyring.
And I am Jeff Hoops.
And we're here to chat
about taxes.
Hello and welcome to Tax Chats. I'm Scott Dyring, professor at Duke University, and I'm joined once again by Jeff Hoops at UNC. Hello, Jeff.
Hello.
Today we're going to talk about realization.
Realizations about realizations, indeed.
Realizations about realizations. Not the kind of like self-realization that you might read about in the self-help section or anything like that. This is about taxes, of course, because what do we do on this podcast, Jeff?
We chat about taxes.
About taxes. It turns out the principle of realization is like ubiquitous in our tax code as it is currently written. Maybe not ubiquitous, but it's everywhere. And there's kind of two key underlying principles. And it goes kind of like this. If I want to tax something, if I'm the government, I need to know how much that thing is worth. I need to have some value on that thing. And we can guess what the value might be. I might guess, the government might guess, 50 people might guess, but it's hard sometimes to guess what the value is without seeing an actual transaction. So you might have some asset, and the asset might have gone up in value. You might have some, what some people might call paper gains, or some economic gains, or whatever you want to call it. But you don't really know for sure if those paper gains are actual they may not actually flow to you until it has been realized in some way. And so if the government wants to tax something, they tend to want a value, and one way to determine a value is if something is realized in a transaction. And the second reason realization matters is when the government taxes an individual or a business, one key principle is that the taxpayer should have the ability to pay that tax.
You got the cash.
You got to have the cash. And if you don't have the cash because all of your gains are paper gains and you haven't realized those gains, you might not have any cash with which to pay the tax. And so underlying this principle of realization are these two principles of valuation and liquidity, the ability to get the cash.
And to be clear, when you're talking about realization, what do you mean by realization? You've said that word many times without telling us exactly what it is.
Yeah, so when you realize something, it's, I guess the way I would think of it is it has been sold and you have now achieved or received the cash for the thing that you sold. That's like a simple definition.
It gets way more complicated in the real tax world, but we're just going to say you sell it. You've realized something because you sold it. Somebody else is willing to pay for it. You know how much they were willing to pay. And we say somebody else is important. That somebody else is independent of you. They bought it because they were trying to get the best price for them. You sold it because you were trying to get the best price for you. You met somewhere in the middle, and that price is the market price because you and them created the market.
Yeah, and I think that actually raises another issue and a phrase that we often throw around. When we talk about realization and valuation and so forth, the transaction is supposed to be arm's length, meaning I want what's best for me and you want what's best for you, and we are not colluding. We are each acting in our own best interest.
Which gives us the price that's actually like the real price.
Which gives us the true price. But if Jeff and I are brothers and we want to somehow fake a price, either too high or too low, we could collude to create a transaction which gives us not the true price because we were operating in cahoots, so to speak. Am I thinking about that correctly, Jeffrey?
Sure. I mean, often the way these are structured, for example, if the two brothers that are trying to collude had the same tax rate, it might not necessarily work out that well because there's symmetry in the way these things are taxed. But yeah, so you want two independent parties transacting. And it should be, noted, we've said, unless you actually sell, you don't know the price. There are some instances in which a market for something exists so that without actually selling, you can still know the price. But that's because other people are realizing. Like the market makes it all possible. So if I own, Walmart shares, which I do because Walmart's amazing. If I own Walmart shares, I know like on a millisecond by millisecond basis exactly what those are worth. And it's not because I like do some valuation exercise with Walmart's financial statements. It's because there is a market and other people are realizing, and I can observe from their realizations what my actual market value is worth. But that doesn't exist for a lot of assets, but it does for some assets.
And the key thing there is other people are trading essentially exactly the same thing. So it's
exactly the same, not essentially exactly the same.
Exactly the same thing. It's not like, oh, it's close or it's in the ballpark. No, it's like exactly the same thing. So it's very easy to tell what the actual value is. So that helps with valuation, but it does not help with liquidity, right?
Correct.
So Jeff, we might know exactly what Jeff's Walmart shares are worth, but if we tax him on the gain in those Walmart shares, he may not have the cash to pay unless he realizes his gain by selling them, in which case he would have the cash to pay, and so liquidity comes into play in that way.
Yeah, which for why Walmart shares doesn't really matter that much, right? I'm not going to. I don't like control Walmart. I didn't found Walmart, but in other instances, it is a big deal. If you founded a company, for example, and you were forced to sell some of that company, then you would lose control of that company, and it could do things that you don't want to do. If you have some piece of real estate or some other item like that, and you're forced to sell to be able to cover a tax bill, then like you won't have that asset, and it's not just some asset that doesn't have any meaning to you. Like my Walmart shares are just basically just good because of the investment value of them to me, that have some other purpose for you. So that liquidity thing is important.
Okay, so realization rears its ugly head.
It's beautiful head. What do you mean ugly head? It's a beautiful head.
I knew you were going to say that, but I don't know. Sometimes I think taxes are ugly, but sometimes they're beautiful, so I'll give you that. Okay, so it manifests itself in many different situations. So let's talk about a few of them. How about we start with probably the most simple, capital gains tax. Should we start there?
Yeah, we've already been talking about that.
That's what we've been talking about. So if I buy Walmart shares, I would choose to do something other than Walmart, but Walmart shares, that's what Jeff has. I have IonQ, the computing company.
And options on IonQ.
And options, which are totally out of the money, so I'm going to lose money on those options. If I have IonQ and the price goes up and I have not sold, I have capital gain is what that's called, but it's unrealized.
Yep, and you don't owe taxes unless you realize.
I don't have to pay any tax unless I realize. How do I realize? I simply sell the shares. Yep. And it's easy to do because it's a publicly traded stock.
Yeah. So that story, I mean, we've told that story now twice in this episode, but the twist on that story, the important part is there's a lot of outrage these days among higher wealth people like Elon Musk or Jeff Bezos or these kinds of people, that they pay very little in taxes. And one of the reasons they pay very little in taxes is because they don't realize their capital gains. It's all about realization. You don't have to pay taxes unless you actually sell stock, and they just don't sell that much stock unless, until recently actually, and Musk has sold quite a bit of stock. But you don't sell, you don't pay, and that's all the principle of realization.
Okay, so capital gains, especially with stock, is pretty simple, but I could have capital gains in something other than a stock. So
like a turkey farm.
Like a turkey farm, yes. Okay, so let's suppose that the turkey farm was still operational. And let's suppose that when I, started the turkey farm, it was worth $500, and after many years, it became
which is big money in Manta, Utah, by the way, $500.
$500. So let's suppose after 20 years of working on the turkey farm, the whole thing was worth something like, I don't know, maybe $1 million. Okay, there's going to be some capital gain built into that, right, Jeff?
Yes.
And it's unrealized because I haven't sold the thing. And the value actually might be tricky to determine.
You said $1 million, but you have no idea, actually.
I have no idea.
Could be $1.2 million, could be $800,000.
In fact, this is kind of interesting. If I say this to my colleagues here at Duke at lunch, hey, how much would you pay for my turkey farm? They would be like, nothing. And if I say this to some of my friends from high school, they might be like, yeah, $2 million. And what is it really worth? And I might say it's worth $10 million because it's mine. Or I might say it's worth $50 because I don't want to tell the IRS that I have made any gains.
And you're so tired of debeaking turkeys.
I'm tired of debeaking turkeys, and what do we do?
Happy to get rid of the thing.
Happy to get rid of it. So, in fact, I'm almost ready to pay somebody to take it from me. When those types of gains arise, now we get into the issue of valuation. So what are some ways that valuation might take place other than seeing something trade? Yeah,
so you could, for example, it turns out, startlingly for those of you, for everybody, actually, I was going to say for those of you who haven't been to Manti, Utah, but for everybody listening in the world, because nobody's been to Manti, Utah, it's actually...
that's not true. There have been at least 50 people go to Manti, Utah.
Yeah. So it's actually like a turkey farming hub of the world. In that area of Utah, there's actually quite a few turkey farms. And so one could, for example, say, well, it's turkey farms on this many acres and they can process this many birds per year. And we find comparable farms and see if any of them have been sold recently. So it's just like the Walmart stock, and you're looking for a similar asset that has been realized recently, except for the difference there is, from turkey farm to turkey farm, there could be differences. They're not identical property. You find a similar item and you see whether it had been sold and see that price.
And you might make some adjustments. And so you might hire someone to do this for you. We would call that person an appraiser, and they might tell you what the value is. But just because you know the value, you have not realized.
Yeah. And what's fascinating about this is it's not just, that value is going to change from farm to farm for a lot of different reasons. The farms could be different, but also you could just see different economic times, right? So it might be that in Manti, Utah, the most recent turkey farm to be sold was 9 months ago. Well, if one of those was before the financial crisis and now you're trying to value it during the financial crisis, you're going to get very, very, very different answers just depending on if we've been in a recession for the last 6 months. So that valuation is difficult. In fact, I have a friend actually who was working out in industry, and the financial crisis actually hit, and they started getting all these advertisements from appraisers who basically wanted to come in and reappraise all of the assets they had during the financial crisis so they could write down the value of all of those for tax purposes and come out with lower property tax values.
Yeah. So that's sometimes we want the things we own to be worth a lot, and sometimes we want them to be worth a little. And this creates incentives for people to opportunistically try to arrive at a valuation so that if a tax is imposed, they have to pay as little tax as possible.
Yeah, which is easy without a market, but which is actually quite hard with a market. I mean, when I moved to Columbus Columbus, Ohio's first house I ever owned, turned out that first year it was pretty ascertainable how much my house was worth because I had bought it a month before. There was a market price.
Yeah. Okay, great. So let's talk about some other places where realization might come into play. Let's talk about estate taxes.
Okay.
So an estate tax is basically a tax on the wealth of individuals who have passed away.
Died.
And
kicked the bucket.
Went
to Davy Jones's locker. Put on a pine overcoat, et cetera, et cetera, et cetera, et cetera.
Well, let's just hope when you kick the bucket, you're not circling the drain for too long, because that can be kind of a drag.
Yeah.
Okay, so you kick the bucket, and your estate now passes on to your heirs. And if you, under kind of like normal circumstances, then if your estate is large enough, and it's pretty large, I mean, it's like $22 million for married couples. Is that right, Jeff?
Yeah, somewhere around there. It changes, but
it changes all the time. But it's say $20 million. Okay,
so it's a lot of money. So to be clear, this is not like most people listening will not be paying the estate tax, but
and unfortunately, my turkey farm wealth is not going to push me over that bar either. So if you're in the if the estate tax hits you, then what happens is somebody's got to figure out what all of the things in your estate are worth so the tax can be imposed.
Well, it's often two people got to figure it out.
Who are the two?
So the two people is you try to figure it out so you can write down, you're dead. So your heirs try to figure it out so they can write down the number on the tax return and say, and remit the amount of tax that they hope to owe on that estate, which they hope is a small value. And then if you get audited, the IRS is going to come in and do the same kind of valuation exercise, and they're going to value those same assets. And if there's a discrepancy, you're going to have to fight it out. So there's actually a pretty interesting. I mean, there's a lot of interesting examples of this, but my favorite is perhaps the estate of Michael Jackson. So Michael Jackson passed away, and his estate came in and tried to value just one of his assets, one of his most possibly valuable assets, his likeness and image. So just like the right to use Michael Jackson's face on something.
Well, hang on. That's a fun one to think about, because my name, image, and likeness would probably be worth negative, or at least zero. Maybe zero on a good day. Michael Jackson's on the other hand.
Depending upon where you allowed me to affix your face, I might pay something for it.
I'm not going to let you affix it in many of the places that you want it to be affixed. Okay, so Michael Jackson, very famous, very, very, very famous. How much is his name, image, and likeness worth?
Yeah, nobody knows, because it was never it didn't get sold at that point, right? So what you had, and there might have been different iterations of this, but I'm looking at a 2021 article in Forbes that says that the estate valued his likeness and image at about $3 million. Okay, $3 million. It's good money, right, for a face?
Seems a little low.
So the IRS comes in.
I mean, he spent more than $3 million on his face.
Maybe, I don't know. Perhaps.
That's speculation. I don't know.
Oh, he should get, I wonder if you have like basis in your face. The face basis.
That's a really good question. We'll talk about basis another day.
Face basis. Okay. So the IRS comes in and says, well, no, it's probably not quite $3 million. They agree with Scott. It's a little bit more than that. So they came in and said, it's $161 million. There's a big difference between $3 million and $161 million. And it was just a matter of fighting it out of court. And so why am I reading this article in 2021? Well, because and Michael Jackson, again, as a reminder, passed away in 2009. It was a long, drawn-out process for the IRS and the Jackson estate to come to terms, litigate, and settle on a final number. And why? Well, because there wasn't realization. If you would have had somebody being willing to pay for his likeness and image while he was still alive, or even just right after he died, and they buy it and there was this market transaction, you'd see that price, there wouldn't be any debate. But in the absence of realization, you have the wide gulf, the Jackson gulf between
the Jackson gulf. Yeah. Which is that's an astounding difference. 3 million versus 161. Is that what you said?
Yes.
Wow. That really is a big difference. So now you might say, how would they come up with the value in the first place? And you would say, well, why don't they go look at similar transactions where someone
There's only
paid
one Michael Jackson.
That's the problem. Michael Jackson is different from every other.
And it actually got even worse than that, is because if you remember when Michael Jackson died, he was like not at a super high point in his career, but he was planning like this comeback tour. He was going to get a lot bigger. And it turns out his death itself probably raised the market value of his name, likeness, and image by quite a lot. They started selling a lot more records. They actually had this, if you remember, this tour where there was like a hologram of Michael Jackson that would sing and dance and do this kind of stuff. So that, his death itself actually increased the value, and it's hard to ignore that, right? To ignore the fact that when he died, he wasn't as famous as 6 months later. So it gets tricky.
Okay,
without
so
realization, it gets tricky.
Luckily, most of us don't have to worry about the value of our estate because we don't have enough wealth. And most of us don't have to worry, especially about the value of our name and image and our likeness and so forth. But there is something that most of us, or many at least, do have to worry about, whether you're, uber rich or not so rich, and that is property taxes.
Yeah, we mentioned this a little bit. Property taxes.
So property taxes are something that basically every homeowner pays, and lots of people own homes. And what happens is at the end of the year, and it varies by municipality and whoever is imposing the tax, but periodically the taxing authority will determine the value of your home. They will assess the value, or they give it's like an appraisal, and they'll say, okay, Dyering's home is worth $500,000. And if Dyering's home is worth $500,000, then we apply the property tax rate to $500,000, and that's how much Dyiring has to pay. That gets a little bit complicated because I might have paid $250,000 for my house, and then property values have gone up and up and up and up, and periodically the government says it went up more, and soon I'm paying tax on wealth of $500,000 that's in my house, but I haven't realized that increase. It's just a paper gain.
Yep, I mean, you're talking North Carolina increases. If you live in parts of California or other places, you might have bought your house in 1960 for $5,000, and now it could be worth $3 million. And that's a big increase, it turns out. And it might be that your career will allow you to pay property taxes on a $3 million home, but it might not. And different jurisdictions handle this differently. California actually might not have to pay, they might not actually adjust the appraisal value, but some jurisdictions do.
And so it could be the case that when I bought the house, I was just paying a small little amount of property taxes, maybe a few $100s a year, and now it's turning out to be a couple $1,000s a month. And if my income hasn't grown proportionally, I could be priced out of my house by the tax system.
Yeah, and this is, I mean, some people would blame gentrification on, this whole issue, this whole property tax issue, in that these houses rise in value. You could get a lot by selling it. Your property taxes increase. You don't necessarily have that cash, and so you move, and so you just change the whole nature of an area because of a lot of reasons, but including property taxes. So again, that was you have the valuation issue, which for property taxes we've talked about. Again, you're going to argue over how much your house is actually worth in the absence of a market price. But liquidity is also an issue, especially when prices rise dramatically, especially when you hold the property for a long time.
Okay, so that's one. And again, the way to think about that is a property tax is a form of a wealth tax. And in many situations, you get taxed on unrealized gains, and that can create problems of liquidity and valuation. Okay, let's talk about another one. Let's see, what have we talked about? We talked about charitable contributions. Let's talk about charitable contributions. How would the principle of realization arise in charitable contributions?
Yep. So if you give something to charity, nobody's paying for it, so you don't get a price, right? So it's the same kind of issue where without a discernible market price, if I give a painting or give an item from the tax museum to a charity, I'm going to, if I itemize, I'm going to get a charitable contribution deduction for that donation to the charity for the market value of that asset. I have to know the value of that asset. And it turns out there is not a robust market in most tax museum items. And so it's going to be my job to value that item. I'm going to put that down as the deduction amount. But if I get audited, the IRS, just like with the estate taxes, are going to come in and they're also going to value it. And we're going to have to agree on a value through the litigation or at least just discussing with the IRS. So it's through the settlement process. So again, you don't have a market sale, so you don't have a market value. And so you just have to guess.
Let's think of some examples of things that I might donate to the tax museum that, and then we'll think about how complicated this would be. Let's suppose I just write a check, cash. I give cash to the tax museum. Is this an issue?
Well, it's never going to be an issue since the tax museum is definitely a for-profit organization. But let's assume we were a non-profit. No, it would not be an issue.
Not an issue.
And in fact, the rules for charitable contributions take this into account. You can donate as much as you want in cash, and all you have to do is literally just write that amount down on your tax return. There's no documentation. There's no separate forms. You don't have to get any kind of appraisal. Nothing. It's just cash because the value of cash is cash.
It's clearly known. Okay. Now let's take it one step further.
At least until we get into hyperinflation times when you have to get a minute by minute value of the cash.
That's right. I might leave my house thinking I'm giving you something, and by the time I take my wheelbarrow full of cash to the tax museum, it's not worth anything anymore.
Yeah.
Okay, but we're not in hyperinflation, and we're going to hope we don't go there. I don't think we will. Let's talk now about something slightly different. What about a share of a stock? I own my amazing IonQ stock. I give you the share. What do I do?
So likewise, there's a very ascertainable market value. We know the price. There's not much of a valuation issue.
Okay, so we can figure it out. It's fine. Now let's take something a little more complicated. Let's suppose that I donate to the tax museum the socks I was wearing when I presented my first accounting paper. That had to do with taxes, tax avoidance.
The value is quite ascertainable. It's 0. And so there would be no issue there. But let's assume they did have some kind of value, which I think is what you're trying to get at here. Then like who knows what these socks are worth? This is one of the most cited tax accounting papers ever on earth.
So I might say I presented this paper as a brand new, actually a PhD student, presented long-run tax avoidance, first paper I ever presented in a public forum. And let's suppose that I was wearing some really nice smart wool socks. And because my paper has now become so famous, maybe people will think it would be cool to own those socks.
It's not just cool. It may have been that the socks themselves made the paper what it is. And anybody wearing those magical socks will have such a famous paper.
Given that so much of my brain resides near my feet, like referee in basketball, that's possible. They might have some value.
Correct.
Okay, so that's more tricky. So, and to give that, you say nobody's going to donate socks to the museum. That's true, but people donate socks all the time to Goodwill.
Oh, one of those famous cases.
Bill Clinton.
Remember Bill Clinton's underwear? Yeah.
Bill Clinton, on his tax return, he donated some clothing to Goodwill, including his underwear, and he recorded a value for his underwear.
What's fascinating about that is like the market value of Bill Clinton's underwear is probably actually quite high. He probably undervalued it in reality if he actually would have sold it on the market. But.
Yeah. So this gets to the issue of making a charitable contribution with something other than like cash or a stock or something that's very liquid. How do you value it? Well, at least at the Goodwill that we take stuff to, you go down there and they hand you a piece of paper and basically you just write down, this is how much it's worth. You just guess. And probably nobody's going to care unless you make a really giant claim that is clearly falsifiable.
The tax system actually takes that into account because it was very big. You have to fill out a separate form and then it gets more complicated.
Yeah, so people aren't going to care really if you make a $10 donation of your underwear and your socks, but if you make a $20,000 donation of a car that is like Jeff's Yaris, you might get audited.
The gold-plated Yaris.
It would have to be gold-plated. Actually, I think there's people who might be, Jeff might be willing to pay money to take the Yaris off his hands, but nobody is willing.
Not true. The Yaris is amazing. Okay, we got one more place where realization exists.
Where's that?
It is, it's actually a place you might not think of, but it is in the case of income shifting, transfer pricing, these types of situations with multinational companies. And the situation here is where you have a large company that operates in multiple jurisdictions. Let's take the jurisdiction United States and Ireland. The United States has a higher tax rate than Ireland. You might face incentives to try to recognize economic activity in different jurisdictions, right? You want to have your expenses where tax rates are high. You want to have your income or your revenue where tax rates are low. And so one way that multinational corporations do that is through what we call transfer pricing or income shifting. There's all sorts of ways we talk about this. And it all centers around transferring assets where you don't sell between related parties. Transferring assets or services. And so how does that work, Scott?
Well, so we talked about this very briefly earlier. We said, what if there's a transaction between brothers and they're not doing it in the same way that an unrelated party would do? Here what you have is two separate legal entities transacting with each other, but the legal entities are controlled by exactly the same people.
I mean, what's fascinating is we literally call the head, the one on the top of the chain, the parent. It's like a familial relationship. The parent and all the little subsidiary children.
The parent and the children, okay? And so the parent entity transacts with the subsidiary entity, or it could be two subsidiaries transacting with each other, so like siblings. But what creates a bigger advantage here than, say, for example, two brothers that live in the same place, one of them resides in, for example, the United States where the tax rate is high, and one of them resides in, say, Ireland where the tax rate is low.
I mentioned that symmetry. Usually the symmetry makes it so it isn't as advantageous as you might think. Here, we eliminate the symmetry because they're in different jurisdictions.
And so what I, as a company, am trying to do is move my income from one pocket in the high tax place to another pocket in the low tax place. And to do that, I have to value the things that I'm shifting around. So if Apple has a patent on, say, an iPhone, and every phone that's sold generates some royalties because that patent is valuable, if Apple can sell that patent to a subsidiary in a low tax country, then all of the royalties will be received in the low tax country. But you say, well, when they sell the patent to the low tax country, won't that be taxable in the high tax country? And the answer is yes, it will.
But at what value?
But at what price? And because there aren't a lot of people out there selling patents for iPhones, nobody really knows what the price is. And
so this
the
is
two
actually a super
companies
important
can
part.
collude.
It's not that there's not a lot of people. It's that a patent itself is literally the right that nobody can. It's like, it's not that like this, you know, there's not there's many turkey farms that are kind of similar, but a patent itself is, there is not this exact product. By definition, that's what a patent means. Nobody else can create this thing.
Yeah. So if I sell a patent, by definition, it's an illiquid market. There isn't anything quite like it, and nobody knows what the value is. But I might claim as the company that it's something low when I sell it because I want the tax that I pay to be low. But once it gets to the low tax country, then suddenly I want the tax to be high so that every royalty I charge will be a high royalty.
You want the value to be high.
I want the value to be high so that every royalty that gets paid, it reflects that high value, and all of the income ends up in the low tax country.
And the tricky part here is that the company has all the information that you would use to actually value the asset. They know they have projections for the future cash flow. They can time when the transaction happens so that like it could be in the process if it's a drug that's like right before FDA approval, so that there's way more uncertainty about the value. So it's not just that there's not a market, it's that the information you would use to value is held by the company, and they can kind of control the nature of that information by controlling the timing of the transfer.
Yeah, in fact, a very fascinating example of the timing and the information asymmetry between, they say the government and the company happened with Uber. So Uber, when it was kind of in its initial stages, would go get some funding from investors. And when you get funding, you kind of know how much the company is worth because they're buying a certain percentage of the company for a price. Well, Uber then started realizing that it wouldn't take long before they were making a lot of money, and it would be advantageous to have some of their intellectual property, their patents and copyrights and so forth, located in a low tax jurisdiction. So Uber made arrangements to sell its intellectual property to a subsidiary, I believe in the Netherlands, another common location for these types of transactions. And it sold that property for a price that reflected its valuation. But like a week later, they went and raised a new round of funding, and the valuation went up 100 times. Now, it's not a coincidence that they made the transaction before getting the new round of funding, because the new round of funding would make it obvious what the value of the company actually was, the value of these transactions, because a sale had essentially taken place. But the old round of funding was looking at something which was much less valuable, so they made the transaction before it became obvious what the actual price would be.
Yeah, and again, just to go back to why we're talking about all this, is that because there's no realization, they didn't, with the patent, for example, going back to the patent example, they didn't sell the patent on an open market where there are all these different bidders and there was independence between the buyer and the seller. You just don't know the actual value, so it's hard to tax, and so you get into this issue that without realization, you get these valuation problems. Which goes back to why, in most instances, we require realization.
Yeah, very good. Well, there's lots to realize about realization. It's a very fascinating topic, and it is a fun one to discuss. And it will probably come up repeatedly as we have these chats because it is so pervasive in the tax system. Any final words, Jeff?
As usual, no, nothing.
All right. Well, thank you for joining us on this episode of Tax Chats. We hope you'll tune in next time. Goodbye.
Goodbye.